Ladies and gentlemen, it has come that time for our February edition of our strategy meeting. This is where we bring our trading team together and we go over some themes and some ideas that we are anticipating for this month and a little bit onward. We're going to welcome in our entire trading team. We're going to start with chart trader, and this is Brett Manning. And Brett, I have to tell you, we have had a lot of market fervor over the last couple of weeks. We've seen Reddit really hit the mainstream and GameStop. And I'll tell you what, Brett, if my mom is texting me asking about it, then it's really hit the mainstream. So now that we've got a new crew of participants in the market, are we actually nearing a top? Here we are at around the 3,900 level in the S&P. Love to get your thoughts as to where we are in the market.
Howdy, Jim. So, yeah, I think that that's obviously the big question on everybody's mind. And we have, we've got something that superficially looks like a mania. But that, as I put in my notes this morning, to call this a bubble right now really kind of disregards the next $2 trillion set to roll into the economy. So there's a lot of reasons for why there's this kind of fervor. There's this kind of momentum coming into everything. I've been bullish, broadly speaking, but not bullish enough. I'm exposed on the long side to the market in kind of an unleveraged passive sense, and I've been looking for some kind of pullback. But the explosion that we've seen higher, I think, really goes back to de-escalation of uncertainties. I published my new chart book last week, and I called it Great Expectations because the great expectations really come on the other side of de-escalation of uncertainties that we had built in coming into November, really around politics, around monetary policy, around fiscal policy, and obviously around the pandemic and the vaccines. And so we've seen the vaccines roll out. We've seen the seemingly impossible impasse in politics kind of unravel into something that makes a more traditional type of sense to people. We've seen the Fed really reaffirm where it stands on policy along with other central banks, and probably in the easiest possible way. And now we've seen a route to getting more fiscal stimulus to come pouring into the market. So really all those uncertainties have de-escalated, and that's led to this great expectation situation. And I think the most poignant way to put it is something Gavin and I talked about last week. According to the Bank of America Fund Manager Survey from January, portfolio managers' expectations for global earnings growth, rising inflation, and higher bond yields were all basically at all-time highs for that survey going back several decades. So everybody is basically the most certain ever that we're going to see an excess of growth and growthiness. When you get that higher bond yields, you're talking about a steepening yield curve. You're talking about economic drivers really kind of powering things, and we're moving toward maybe what is being thought of as kind of the greatest ramp up in pent-up demand maybe ever, given the sort of, the narrative around the rollout of the vaccines plus another, let's say, $1.5 trillion of stimulus coming into the market. So there's that carrot out there, and it's huge, and the market's doing its best to try and price that in. But at the same time, something I noted this morning, and I've kind of kept an eye on a bit, is you've got to appreciate that this still exists on a spectrum. And the best way to define that spectrum is you got at one end risk aversion, like complete risk aversion. Think of September 2008 or March 2009 or March of last year, complete risk aversion. That's one end of the spectrum. And at the other end of the spectrum is complete risk acceptance. Right, and markets always exist somewhere on that spectrum, and rallies like this, as they get intense, they're really traversing that spectrum. And when you get to the point where you have basically everybody lined up with kind of wholehearted risk acceptance, there really isn't a whole lot further to go. And something that I pointed out yesterday and this morning is you're starting to see some signs of a level of risk acceptance that historically has been really problematic. So one of the measures I talked about this morning, if you look at the OTCQB index, right, you're talking basically pink sheet stocks. You're talking about companies that move forward on convertible debt that's basically like death spiral terms. And those stocks are up 76% on an index level in the last 2.5 months, and 18% in the last couple of weeks. So there's just a parabolic trend in what looks like pink sheet stocks. You have junk debt right now being offered at the best terms ever. So basically, if you qualify just at a junk bond level, you're getting the lowest interest rates ever for people to lend to you. And some of that has to do with just so much money in the system, the expectations of so much money coming after it. But it still suggests that we're getting to a point where we have an unsustainable level of risk acceptance. That doesn't mean is it the top capital THE, but in my opinion, it likely means that we're headed towards something that at least suggests a kind of shakeout that could be somewhat intense, because the other thing that we've talked about quite a bit lately is there's so much excess options activity. So much of this market is being powered by call bets. Really, calls are piling up everywhere. That's why we see a 2-decade low in the 50-day moving average of the CBOE total put call average. That's just massive call buying. That means you've got this delta problem where the market tips just a little bit and the snag hits for margin calls a lot earlier because a lot of that is on a leveraged instrument. So we could see a trap door before too long. It probably is something to buy.
I will say this much too, on the same vein as the excess option activity, the call buying that you talked about, and I'm going to highlight one of the feedbacks we got today, and I think it stems from a lot of the Reddit buzz. And the question was asking about a stock, and I quote, "Do you have any YOLO recommendations for these call options?" And anybody who doesn't know YOLO, you only live once. And if you've spent even 30 seconds on any of the Wall Street Bets Reddit feed, you'll know that that's kind of a big theme, and people going at it, taking a lot of money, and just, hey, you only live once, and I'm going to go all in, make it or break it, go big or go home.
Yeah.
And let me tell you, this is the last time I'm going to even mention that, and I bring it up for a teaching opportunity. We're not going to do that here. We're not going to give you those type of plays. We want to keep you in this business for as long as we can. We all are teachers at heart, and we want to see you come back tomorrow, not, hey, cash out and come back a year from now and try it all over again. That's not what we're all about. With that said, that type of mentality is out there, Brett, and I think it's a danger game, and I think that could be one of the catalysts that we see where when the trap door just suddenly falls, that's who could be left holding the bag. And I think it could get it could stem a lot farther than what most people are actually thinking or used to where this 5 to 10% correction could extend even further and faster just because these people have not even seen that type of action yet.
No, there's no question about it. There's a space in there for the market when it breaks just enough, when it cracks just enough, that I think we're going to see what I call a banana peel or an air pocket, where you're going to see some really, really fast downside movement. But it's going to ultimately hit a point where you're going to see a lot of money. There's so much money that's going to be looking ahead still at the world as it appears it may be several months down the line in terms of this massive unleashing of pent-up demand mixed with trillions of dollars of more stimulus. That's still sitting in front of us, and it's going to be awfully hard for there to not be a safety net bid, but it will be after a pain point is passed and after a threshold is passed where, yeah, I think a lot of people who have decided to approach the market in that way are going to get hurt badly and very, very fast.
So what's the key to avoid that? Let's bring everyone into the discussion, because over the last 2 weeks, that was a big talking point of all the news sources, right? We've got people talking about GameStop. That's all anybody wanted to talk about. Gavin was mentioning he was having a little powwow with some friends, 10 friends, and 3 of them all own GameStop. I'm sure they didn't own it from the $5 region and just say, hey, look what happened. You know, I was one of the believers in this one. I'm sure it was Johnny-come-lately money. So with that said, guys, how do you avoid it? Or how do you take advantage of this?
Yeah, blue chip trader here. So I've been taking full advantage of this over the last couple of weeks and whatnot. We've mentioned a lot how a lot of these low price names do have a theme surrounding them. They are surrounding the marijuana play, the marijuana stocks. They are surrounding the electronic vehicle, alternative energy, battery sort of plays. They are surrounding the 3D printing plays. So there's definitely this common sector or industry, or sub-industry theme going on here, which is it's really nice to kind of latch on to something like that. Even throw in the SPAC plays as well. Um, and I think there's just a lot of money to be made. It's fast money. And I think that's the key word that you have to understand if you're going to get involved in these. It is fast money. So trade them, jump on board, go with the trend, find a good pattern, latch on to them, but don't get married to them. Clearly, the fundamentals are, way lagging behind the price action and the valuations, and just ride that train and ride the momentum as it continues to play out. And just understand that when the music does stop, you better, not be caught holding the bag, and you have to wind up, changing gears a little bit, and the market's going to go back to some sort of, I guess you can call it normalcy. But this is the market environment that we're in right now. So just understand that it's fast money, it's fast trading. Um, I don't know anybody who's really thinking that they're investing in these things and holding on to them for months on end. At least not the people I come across. I mentioned with Gavin on Trader Audio 2 weeks ago, my electrician was coming in my house for 3 days in a row, and before he came into my house at 10 o'clock each morning, he was telling me how he made a few $100s trading GameStop and AMC, only buying like odd lots and stuff. So, and he's got it down. He understood the heightened volatility. He understood that this is just the hot thing in the moment, and he was willing to just capitalize on a few points here and there, for small, for just small gains. He understood the concept of trading. Other people who were buying the GameStop at 400 after a 1,000 point run up, 1,000% run up, and holding on to it as a lifer, you deserve to lose. It's plain and simple. If you're not using common sense, you deserve to lose. I don't know if it.
I want to
Yeah, go
add,
ahead.
this is Scout. So yeah, this is an interesting moment in time. The price action is suggestive or reminds us of some of the tops we've seen in the past. But the participants seem a little bit different. It feels like roaming hordes of speculators raiding a new town every day. And they just move from town to town, pillaging what they can and just moving on. Versus periods in the past, you did have people getting into the market because it was going up. There were hot stocks going up on the news, and then they were coming in and kind of marrying these stocks and getting hammered when they pulled back. And so, yeah, as I pose this question to the group, you guys feel like this is a different setup than we've seen in the past, where all of these red lights are going off, saying top, 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 market implosion coming. However, it just feels a little bit different. And I'm prepared for pullback. I'm hoping for a pullback, but at the same time, I'm not being aggressive, right? I don't have on a bunch of hedges because I've been thinking we've been due for a pullback for probably 6 or 7 months, right? And I would have missed out a lot of opportunity if I just moved to the sideline. So just want to get you guys' thoughts on kind of where we stand and if this looks different from what we've seen in the past.
I think it does. This is blue chip again. I've mentioned this in prior strategy meetings. I think what we saw in 2020 during the March COVID crash was probably one of the fastest recessions on record and the fastest recuperations. And the market showed that from a breadth perspective, from a historical perspective, correcting over 35% and then recouping those gains within 6 months later. You had sector rotation the whole way through the prevailing uptrend over the course of almost a year now, and that is usually a healthy sign of a market when you're going from area to area. A lot of references are made to the current environment being so speculative, similar to the 1990, late 90s era, 1999 era. My only argument against that was that it was very technology driven back then. It was very internet bubble sort of names that were really kind of rocketing higher. Semiconductors were kind of thrown in there as well. as I mentioned a little earlier, this seems to be spreading around. It's various industries. It's not just one specific group that usually tends to go parabolic. This is like 5 or 6 different industries unrelated to each other. 3D printing to marijuana to autonomous robo electronic vehicles. It's all over the place to biotechs. I mean, this is some sort of, like you said, Damon. It's like this group of pillagers going from town to town and just going on and attacking each themed, week by week, and that's kind of bullish in my mind. And I think if we're coming out of what was probably the fastest recession we've ever seen, and if the economy is going to start opening up and people getting vaccinated and businesses and things are going to be, pushing forward here over the course of the next year or so, interest rates are real low, et cetera. I mean, the market's going to continue to drive higher, and then inflation is going to kick in, and then everything will turn, probably to put the brakes on everything after that happens. But right now, I'm willing to, ride the new highs, ride the trends higher. Every time I think I try getting short a stock that looks extremely bearish, maybe I get a point or two to the downside before it turns around and squeezes on me. It's really, really difficult to be short this market. The market's very, very strong.
I would agree with every point. This is Brett, chart trader. The one thing I would take issue with is the idea that this is in a completely brand new early stage bull market. And
it's
obviously
late stage. Yeah.
Oh, okay, so I thought you were implying that you got the entire cycle done.
I think it started, the new stage started probably COVID related and whatnot, and then early spring, summer last year. It definitely feels like this is more retail involvement, and as we said before, it's the final innings. Whether we're in the end of the 7th, 8th, or 9th, I don't know where we are. We might even, Gavin joked around about, he said we're in extra innings. We're definitely in like the 10th or 11th,
Okay, I thought you were saying we were in the new first inning.
No. I think we're somewhere around that 8th, 9th, possibly even extra inning time frame.
Yeah, okay. So it's not completely different this time. The one point I was going to make in evidence of that Gavin and I talked about is that short interest across the market is at a 20-plus year low. So we're already at the point where there's no bears left. And yeah, we've got this big influx of retail interest. So we're at a point where, sure, as to Damon's point, it's different. There's a lot of things that look a little different. But I don't know if you can say it's completely different. We're still late stage bull market with a lot of speculation that is broadly spread across instruments. We've got, just like I said earlier, we've got junk debt that's the best terms you can ever get. We've got the OTC stocks rallying like crazy. We've got no short interest in the market. Those things are all still true, even though it looks like there's these defined things. We've also got the most stimulus ever. And we've got some real things to back it up, and it doesn't mean that necessarily this is going to end anytime soon. It's just it's the flower's blooming. It's not a stem. The flower's blooming, and eventually the petals will fall off it.
I mean, I would say we're somewhere maybe 1998-ish. That we can
last
easily.
One we were at 97, now we're at 98. Yeah, all right.
That makes because like you said, Brad, this is the late stage of a bull market. The speculation is running high, but there's no telling when that ends, right? I mean, unless you have some sort of crystal ball that can tell us. This can go on for another year.
Right, the real silver bullet looks like it would be inflation at this point, and it's tough to find another silver bullet.
Yeah, I definitely take 98, 99 again. Those were good days.
Yeah, they are, and they've been great days here lately. I mean, this is a fantastic start to 2021 from my perspective.
Event trader here. I think everybody's really hit on some of the primary talking points when you're looking at this. I mean, Brett was talking about the amount of monetary and fiscal stimulus going in. It was amazing to see last Thursday, I think Lawrence Summers wrote an op-ed for the Financial Times talking about how he thought that the Biden package was too big. Now we're talking about a guy that was the economic advisor for Obama. So certainly in the Biden administration camp, and when you see him raising the question, do we need any more stimulus? Definitely, but it shows how much liquidity is out there. I think one of the other aspects, and we'll talk a little bit more and deeper with this with Damon when he talks about the SPACs, but Brett was talking about a new party coming to the pie, and it's not just the retail, I think, but also a lot of those dark pools with the venture capital. Given all the SPACs that are coming out, probably lots people who had lots of money stored up on the sidelines that we talk about that didn't want to chase into some of these VCs because they had missed the entry boat. I think some of them are finding their way into these SPACs and just really providing another asset pool out there that's just lifting everything across the board. And when we talk about monetary and fiscal stimulus too, it's not just here in the U.S., but globally. One of the things that Brett and I talked about in the Sentiment and Flow show was the money flows into the U.S. was the highest that we'd seen in 60 years. So there's just a natural lift to asset prices that are going to be in play here and going to continue that way as long as the financing for this remains cheap. And that's why the bond market is definitely, I think, the key for how long we could keep afloat here, because we've talked about the rising yields over the last couple of weeks. And, we got up to 119 yesterday, which would have been a 11-month high, just about at 52-week highs up around here. And we'll hit that soon enough because we're going to get that lap over period where yields just kind of collapsed during the COVID crisis. So all this is factoring in, but there's just too much liquidity out there. I know Brett always uses the analogy of trying to push a ball under the water in the pool. And I mean, I think you're seeing that really play out here. What inning we're in, you can't really worry about that as much because you're probably not going to pick a top. If you do, you'll be able to tell all your friends about it later on down the road. But for now, I think, and you hate using the term keep dancing while the music's playing, but that's where we're stuck in. And I don't see it going down until we see something a little bit more disruptive on the borrowing rates. Craig, you got something here?
Yeah, this is Trend Tracker. I would agree with that. It does seem like rates are kind of the wild card, and there's a difference between when we're talking about innings, whether or not it's seventh inning, eighth inning, or much earlier. There's a difference between the economy and the market, right? Where the economy is expected to be strong this year and likely next year, but me, I'm more focused on the bottoms up, stock by stock kind of analysis. And so I've kind of wavered back and forth going all the way back to last April since the sharp recovery off the bottom from being concerned we were going to roll back over to, okay, the coast is clear, and then I'll have a strong month or two where I'm buying and not afraid about a pullback. So, I think we can continue to climb the wall of worry, but it does seem like we are very much overdue for all this retail money and all these speculative parts of the market to kind of get washed out and punished. But based on the economic outlook, one would think that does set up another buying opportunity. So, all the corrections we have seen in recent years, even before COVID, corrections seem to have gotten faster and sharper and quicker. So, even like we saw, was it a week or two ago, I think it got close to a 5% correction in a matter of a day or two, and then it was over. So, it's very important to stay nimble, but we are seemingly due to wash out a lot of the speculative activity, but it would likely create just another buying opportunity given the economic outlook.
I would say this: I'd bet money on that when we do get that correction, it's going to set the record for the fastest bear market that we've ever seen. So it's going to be aggressive to the downside and quick.
Yeah, I mean, it always has been in recent years, and obviously, March of last year was the most glaring example. Hopefully, we don't have to experience anything that extreme again, but we definitely are all staying nimble, that's for sure.
Well, guys, if we are in the late innings, timing it is going to be always a problem. However, understanding where the risk actually is and where the vulnerable spaces are is at least a step in the right direction. So, with that said, when the bow breaks, which areas should we be looking at to maybe either capitalize on the downside or get prepared for our shopping list?
Well,
Are you asking like what I'd be
Well, yeah.
shorting
Well,
on a downturn, or what I'd
sure.
be looking to
Should we be
buy on a?
looking at
I think
names? Should we be targeting names that have a very extreme low short interest? Are those the ones that are going to be the most vulnerable? Are those going to be
well,
the new hotness that people are going to be attacking because everyone's scared off of trying to short high short interest names because they've seen what happened? So maybe they just do the opposite.
yeah, I mean, I think that's part of the dynamic that we've seen in recent weeks and months, where the most obvious shorts based on, valuations are the things that have gotten people's face ripped off. Electric vehicles, um, 3D printing, a lot of the most speculative stuff with the highest short interest is what's really taken off, which I guess could be viewed as the shorts capitulating. Um, Brett was pointing out, was it the IWC micro caps have gone vertical, and I think the small caps have pretty much done the same thing. So I guess IWC, IWM, the smallest, most speculative stocks are where the most froth is. Um, but the S&P 500 is trading at 23 times earnings, so even the large caps are relatively expensive based on the historical metrics.
And the reason for the decline would be important too, as I think debt levels would be the first thing people would go if we saw the sell-off due to higher rates. Anybody with excessive debt, anybody with a high EBITDA, debt to enterprise value or anything along those lines, any of those metrics would be the first ones attacked.
How about a Reddit Wall Street bets out of the money put attack on Melvin Capital's long holdings?
Hey,
Could
that's
be
as
that.
good as any. Do they? I wouldn't be surprised. Hey, what are you working for them now, Brett? You got some inside scoop? All right.
Yeah, so one thing I would add, just regarding the shorting, potentially shorting, I question whether it's a game you even want to play, right? So just given I look at my portfolio and the number of triple digit and quadruple digit gainers I have in my portfolio, literally dozens over the past year. And I think, is it worth focusing your time on trying to make 20% on the downside pullback, or should you really just kind of be standing back, waiting for the decline so that you can identify long side opportunities that have the potential to go up 2x, 3x, 4x, 5x? So I think it's a matter of priority and just kind of, where you're going to make the most money long term.
Yeah, just to tack on to what Damon's saying there, I think it comes down to just good risk and money management disciplines. So when the market does eventually start to correct, and usually it's pretty obvious. I've said this a lot of times. As a technician, I've watched at least 2 to 3 bear cycles go on in the last 25 years. I've traded through them and et cetera. The market tends to go down in unison. It's not like, usually there's one group that starts leading to the downside that kind of tips things off a little bit, that's a little weaker than the rest. And then the rest of the market loses, starts to run out of steam a little bit. And then everything starts to collapse in unison. You start to see the more safety defensive groups like gold and REITs and staples and utilities start to capture bids. And, that's usually the signal that something's awry and that uptrend might be ending, so to speak. But the key back to my point was risk management and money management. So when you start to see all those signals come about and price action, the major indices are breaking down below the 50-day moving averages along with other sectors, you should be cutting back on share size or hedging your portfolio or slowing down the trading aspect. So if you're not keen on the notion of shorting and trying to make money on the downside, at least don't be adding to what can potentially be a absolutely devastating couple of months of corrective activity. Learn how to reel it back in, pull back in on the reins, lighten up, trade a little less, and just kind of wait it out. Wait for that dust to settle a little bit.
Can I chime in one more thing? And I agree with all that. In this environment, I don't think that you want to be especially if you're not experienced on the short side. The opportunity is probably to let the weak hands shake out of this market and then to look for opportunities, because they're going to be there given everything else that we've discussed. But one thing I would say is the most dangerous thing, the thing that I want to most impress upon people, especially people who are newer to markets, the most dangerous thing to do right now, given everything that we've talked about, is if this market starts to leak slowly to the downside in a very undramatic way, without a big VIX pop, with a grinding type of movement, there's a trapdoor coming. Let that trapdoor hit first. Don't just start to buy and then it goes down a little bit further and you just add more, and it goes down a little bit further and you just add more. No stops, no risk protection, because you put yourself in a position then where that you feel totally confident of some particular stock that you're interested in. You've been waiting to buy on a pullback. It's just gradually moving down, but the market is moving down with it. When that, if you approach things that way, when that trapdoor hits, you're going to be stuck in the worst possible situation where you're married to it, way out of the money, and you start to lose a rational basis for your next action. In this market, given what we know about the put-call ratio, given what we know about cash holdings at major funds, given what we know about things like the OTC QB performance, given everything that we've talked about, junk debt, the whole thing, if this market starts to leak gradually down without a big dramatic move higher in the VIX on the first or second day, like we just saw a couple weeks ago, 61% in the VIX on the first big day down, that's a sign that you're basically already done with the correction, as I discussed in my ETF notes. If this is a slower move, if this is a grinding move, if it doesn't look dramatic but the market starts to move lower, because of the options activity, we're going to hit a pain point and we're going to get a trapdoor. You want to be doing your activity, you want to be using your shopping list after that trapdoor. Don't buy into a slow grinding pullback at this point.
Hey, that is very sound advice. I mean, I think over 25 years of trading, that's a piece of advice that I think everyone who's been trading for less than 15 years needs to hear, because that is a mistake that is made over and over and over and over again. And I know personally I've made that mistake in the past, which has led me to transition the way I scale into positions. No longer do I ever, especially late stage, buy a full size position. It just doesn't happen. I might buy a third of a size, initial size, a quarter of initial size, because things can get ugly pretty quickly. And even though they're names that you may feel are compelling, really like, and think can have tremendous long-term upside, if you're in a full-size position and it falls 40% in 3 weeks, you're not feeling good about that, and it's very likely you're going to flush out of it. Now, that doesn't even factor in leverage, right? Like some people use leverage, use margin to buy positions. They're down 40, 50%. And they're at the point where they're getting their positions liquidated. So it's really important to keep that in mind, especially given where we are in the cycle. There's going to be opportunity. Don't think about if I'm making money today or this week. Think about the year. And that really helped me in terms of my overall performance, is not whether I'm making money today, but understanding that the goal is to make money for the year. And things that you put on that you maybe scale into over the course of several months, maybe they don't bloom until 3-4 months down the line, even a year down the line. But those, little speculative bets that you're putting on, or long-term ideas, literally one of those can make your entire year. And I mean, if you look at the price performance of some of these names this year that are up literally thousands of percent, I mean, you kind of get a sense of, where the opportunity exists, and that you don't necessarily have to have on a huge position in order to do well.
All right, gentlemen. Very, very sound advice. And I must say, with all that's been going on and things like GameStop hitting the news and being focal point of many people's minds, this might be the least talk about earnings season that we've seen. And maybe it's because it's been not so bad. I would love to get your take, Craig, on where you see earnings. Give it a little report card.
Well, earnings are coming in very strong. It looks like Q4 earnings are going to end positive. I think they were tracking to about plus 1% as of like late last week, which would be the first time that the S&P 500 posted earnings growth since the fourth quarter of 2019. Obviously, the pandemic crushed things starting in March, so Q1, 2, and 3 were all facing comparisons to normal times, and things rebounded extremely well, as we have seen over the last, since April, May. Unless you're in one of the restaurant, travel, leisure type sectors, then corporate America has proven really resilient, as we discussed on the last strategy meeting. So earnings are now expected to be positive for Q4, which kind of just sets up a really favorable scenario coming into 2021, where expectations are comps are very easy, pretty much all year. For the rest of the year, once we hit March, mid-March is when everything just, kind of shut down. So, starting in the last couple weeks of March and for the rest of the year, comps are easy. So that's why the market, from a fundamental perspective, we're supposed to put up, I think, close to 30% growth in earnings, which is, the fact that we're trading at 23 times earnings, which is historically very expensive, it starts to make more sense when you consider the monetary, fiscal, and the support, in addition to the growth that we're expected to put. So it's just like this massive momentum trade that's been building from the bottom last March. So we could argue that now the fundamentals need to catch up to the market, and that's what seems to be happening here going forward. So, there's reason to be optimistic when it comes to the earnings story. The market has looked very expensive since we rebounded sharply in April, May, and over time, month by month and quarter by quarter, the market has done a good job in kind of justifying the gains that we've seen. So the market still looks pretty expensive, but companies are delivering. So.
Well, that's certainly good news and very optimistic. And, we still are, halfway through. So we will probably do another recap of this after probably the next strategy session. However, Blue Chip Trader, I want to bring you into the discussion. You have a way of finding hot names that come out, and let's talk a little bit about your TA scan, because you find a lot of good ideas utilizing this.
Yeah, one of the, there's so much information on briefing.com. We have tons of different columns and reports that all of us contribute to, as analysts. And, we obviously have the trading aspect of it too. But the TA page scans underneath the investing and trading column at the top of the page there, you can go down about 3/4 of the way. You see TA page scans. Essentially, this was a table that I created over 15 years ago, just to kind of narrow down my amount of time that it took me to find quality technical setups each night. Prior to scanning software and technology, back in the late 90s and everything, I used to have to go manually through every S&P 500 stock, every Dow component, and a couple of the NASDAQ leaders, and it was just time consuming. And as I became more of a family man and my time was kind of divided, in certain aspects between work and family, I needed to come up with quicker ways to, search for quality trading opportunities. So I got access to the software, came up with some just basic patterns, simple pullbacks, consolidations, inside days, dojis, breakouts, you're either going up, down, or sideways, and I really want to trade the more momentum based names. So there's, I upped the volume and liquidity requirements as well as volatility. And I just created this table and I update it every single day, and it prevents some really good opportunities. But even more so if you're not even technically based, you can always just take a step back and you can just look at the more bullish setups. Like just recently, I wrote about it today, saying how the power ups, which is stocks that have been running strong on volume 3 or more days, the wide range breakouts, and the overbought sections, which is stocks that have extended beyond their average 5-day range. Um, they were really just dominating the results on the page, and that's usually indicative of a very strong underlying bullish tone that's been going on there. So, you could just kind of interpret it each way you want. But as for the low price momentum names, all the way at the bottom of the table there is an area that I came up with the term zippers. I know it's not the best name in the world. As Gavin's pointed out, coming up with creative names is not really a strong point. But these stocks are basically zipping, as fast and quickly as they can. They're under $25, and they're just showing strong momentum on aggressive volume. And I tried to, when I came up with the scan, I didn't want the one-day wonders. I didn't want those names that just had some release some news press about something or other, and the stock gaps up and then comes diving back in the next day. So I'm not going to give away the secret sauce, but according to the scan, it needs to be beyond just a one-day, phenomenon of a stock just gapping up significantly and then just kind of petering out. It does have to maintain some sort of trend. There has to be some sort of breakout on a weekly and monthly time frame. And then the key thing there is also just to see a few days of consolidation and then watch it continue to grind higher. And that's really what the zippers is designed to do. 3 months ago, I went back in October, 4 months ago in October, there was probably only about 9 to 10 names on that list. And here today, we're looking, I've had to put a couple filters on them. I mean, I think the initial scan reveals about 189 to 200 names. And then I have to up the volume requirements and up some of the volatility requirements just to narrow it down to a manageable amount. And I think right now I'm looking at maybe 89 on the page. And they're just the more liquid, low price names that have been trending higher, significantly over the last couple of weeks, some of the last couple of days. But they're really, really great setups. I've traded probably, I wouldn't say every one, but I've traded at least a few of them. I've shared them on the site with the recent hotness list that I post after the first hour each morning for the last couple of weeks. There's just really great setups that sit along here. And if you're struggling to find some just quality trending names and you're waiting for the breakouts, or you're interested in doing a little bit more research on what these companies do, a lot of them are SPAC related or biotech or marijuana or electronic vehicle, all those hot themes that I mentioned earlier. This is just a fantastic starting point, a little cull list, if you want to call it, to just kind of go through and keep them out there in front of you instead of chasing the next headline that has everything gapping up, 100% in one day.
All right, so I'm going to bring in Craig, which you guys know as Trend Tracker out there. And I want to tell you, Trend is one of the guys who will hold things for a long time. Now, if you are new to the briefing trading service, you may catch this meeting and think, oh, I'm going to listen to it once a month and catch it on the YouTube archive, and I'll be able to decipher things. Well, I'll tell you what, you would have to go back almost 3 years for some of Trend Tracker's stock winners. So just to give you some perspective, he's had some big names like TTD. You've held that one for a long time. Now, we've got to get whatever your hot list is, at least a little bit. Give us a little indication of some of the things you're looking at in your top picks, Trend Tracker.
Sure. Well, I tend to focus on the secular growth stocks. So, this year everybody's talking about how it's all going to be about the cyclical recovery plays, and my cyclical recovery plays, which have been, I've been bullish and long these since April, May. I got to look when I actually first bought Eventbrite. But Eventbrite is one of the stocks where I think it's a great play on the eventual recovery to normalcy. I'm already up a decent amount in this one, but if live events come back like they should eventually, hopefully, back half of the year, um, this becomes a growth stock, and the stock is cheap. It's kind of more like a local event, grassroots type of play on events as opposed to Live Nation, LYV, which is kind of got like a monopoly on like larger concerts and stuff. So Eventbrite, the ticker's EB, is they have like a self-service platform for event creators. And this is one where, it's obviously up a lot off of the lows, but if things turn back to normal, there's still significant upside here. Potentially new highs eventually, which is, $30-$40 a share. Lyft is my other recovery play, which I've actually been long since the IPO, and especially in this market where pretty much everything that's putting up growth is trading at very extreme valuations. This has a very reasonable valuation. Starting March, like most other stocks, it's going to have very easy comps, and it may require, like the airlines, a lot of the business travel and certain aspects of their business might take a little longer to come back. But I really like this cyclical recovery play as this, because it also has a secular growth kicker to it. Facebook is one that isn't super exciting, but it's trading at a market multiple, low teens EBITDA, a little over 20 times earnings. I think this uncertainty with Apple's privacy changes in iOS is just like a lead blanket on this stock right now. So I think it makes sense to accumulate the stock at these levels. Another one I wanted to mention, which I bought yesterday, was this Akerna, which is kind of in the sweet spot right now because it's a software stock that is selling into the growth market of cannabis. This actually came public via SPAC a couple of years ago. Hasn't really done much, but they did make a couple of interesting acquisitions last year. It is very speculative, but it has a reasonable valuation for the story. So this is one of those ones, you can see the volume that's come in since the election in November, just crazy volume in this stock in recent weeks and months. This is one that could potentially go, parabolic. If you look at the chart, it's still kind of early. If you zoom out a couple of years, still kind of trading in the range that it's been in. So this is one that could potentially put up some big gains here this year. So those were the ones that I was focusing in on for today.
All right, good stuff as always, Craig. Gavin, I want to bring you back into the discussion and talk about the global chip shortage. Now, you've highlighted this as a theme that we need to be being very aware of over the course of this year, and maybe even extended upon that. But I want to talk about the ramifications, the impact on the economy, and maybe some plays that we may be able to take advantage of this.
Yeah, and I'll just give an update on what's going on. I think this is probably one of the most underreported stories here because everybody's just kind of been looking at the overall stock market, and because these stocks have been performing well, it hasn't been as major of an issue. But it's definitely something that's going to be a major back story for 2021, unless, of course, they could get capacity up. But a lot of people have been talking about the chip shortage looking like a slow-moving car crash. Basically, it's been talked about for 2 quarters, 3 quarters now, but we haven't really seen much of an impact up until this current quarter, where you started seeing it being referenced by some of the biggest chip makers out there. I'm sure anybody that was trying to get a PlayStation 5 or an Xbox for their kids saw firsthand what the chip shortage was doing, and that was delaying a lot of orders being backed up, and this problem accelerated in Q4. Basically, you got a perfect storm on the chip demand. I mean, you got a 5G ramp up, and 5G 5G chips take up about 40% more content than the prior chips. So a lot of the different components that are being used in there are in even higher demand right now. You also have the hyperscale data center build out going on. Work from home really driving that, as well as a surge in PC demand. So then on top of that, you had a number of canceled orders at the beginning of last year by Taiwan Semi and some other major chip players as COVID hit, and they had to readjust their expectations. So that's also weighing in on things. And then you also had stockpiling around Huawei Technologies as they were trying to get components in ahead of the administration, the Trump administration, shutting down some of their suppliers. So all this is starting to come to roost now, and a capacity build out for a lot of these chip players, it's pretty complicated stuff. So it takes a few months for that to get built out. So we're not going to see really anything going on that front for a couple of quarters here. We talked about Taiwan Semi with their high CapEx number. That's because they're trying to play some catch up with the lack of utilization that's out there. So this is all going to play in, and think of it, everything is based around chips now. It's going to slow down delivery times for lower end PCs and laptop processors that were key drivers for earnings results last quarter. The gaming hardware industry is also going to face a slowdown because of less supply there from the capacity issues. This is going to slow down graphic processors getting put out. And it's also going to squeeze crypto mining a little bit. So, does this help drive Bitcoin higher? But one of the key areas that we're also seeing a slowdown on is for the auto industry, which has obviously been extremely hot with the run in EVs. We've talked a lot about Ford, General Motors, and of course Tesla. Now there's talks that there's going to be 61 billion in lost sales in the automotive industry alone. I mean, General Motors and Ford were both talking about it on their earnings calls, that they weren't able to meet demand because of the lack of shortages there. The auto industry is probably a little late to the game going on here because they're not really used to the lead times that are necessary for these chip demands. And that's going to really weigh in on sales for this upcoming year. And I don't think that's really being priced in when you're looking at the parabolic run that we're seeing in the auto industry. So it's going to be a major story and something that's going to continue to play out here. Now, there are ways to play this, and one of them I jumped in on this morning. That was AMKR, Amcor Technologies, which if you pull it up on the daily, is looking ready to try to break out here to all-time highs at the moment. And where you're seeing a lot of the issues coming in for the semi-play is the back end of things. Now, this is where everything's laid into the motherboard down on the chip, and then it's bonded in. You got your wire bonders, also known as sewing machines, and packaging, and that basically secures everything in place and also protects against overheating by these chips, which are going to be run pretty heavily. So what you're looking for is some names that are just going to see outpaced demand on that as some of these chip shortages come into play, and you're going to be seeing people trying to play some catch up. And this is just going to make for a good 3 to 4 quarter ramp up for plays like Amcor, which is on the packaging side, thus protecting the chips and the circuitry against overheating. Ace Technologies, which is ASX, is another play that I saw in this. This had just run a little bit too much for me. It's up from about $4.20 back in October. It's pretty much nearly doubled since, so I didn't want to chase ASX, but that's another name that I'd be keeping an eye out on. You also have Kulik and Sofa Industries, ticker symbol KLIK. This is one of those wire bonding machines. And you can see just the breakout on these names. And this is just going to continue as you're going to see huge demand for the next few quarters play out in this space. And it's really an area where you have to have some money at play, I think. Another play that could win, we talked a little bit about the problems with the putting together some of these chips. And that really impacts like a Qualcomm and NXPI, some of these higher end chip plays that are out there. We saw Apple mention Qualcomm shortages here. We saw the Qualcomm CEO come out and note that they were having a tough time keeping up with demand. With the complexity of that going on, that usually falls in the smaller chips, the 5 nanometer, the 7 nanometer, and plays like that. Now, we know Intel has been messing up their assembly lines for some of these little chip plays, so perhaps this chip shortage is also going to give Intel a little bit of a reprieve for its late to the market game. So that's another name that could kind of play some catch up under new leadership and not be as heavily impacted by the fact that it doesn't have a good 5 nanometer, 7 nanometer chip right now to keep up with Taiwan Semi, just because that slowdown in chips is going to allow Intel to play a little pickup. So there are a few ways to play this chip shortage. I'm going to continue to be mentioning this. I'm going to post some of these notes, but I think that's an area that you got to keep on your radar in 2021.
All right, now another area that Scalp Trader has had on his radar for a number of these meetings is the SPAC space, and it doesn't seem to be slowing down at all, does it, Damon?
Not at all. We're getting literally dozens of SPACs come public every month, sometimes 5, 6 a day, new filings almost every day. However, I think this is, it continues to be a really compelling space. It's venture capital for retail investors as well as institutional investors. But, for the first time, really, someone who is worth less than $50 million has an opportunity to participate in venture capital. And so we're getting more and more deals from really strong backers, like major private equity funds, major venture capital funds, big names out there. So it's added credibility to the space, and it is a legitimate route for a venture stage company to take itself public. And, for people who are new, I've gone over a lot of the SPAC mechanics and past meetings. I've really kind of been touting SPACs for I don't know how many months now, but really trying to help people understand the significance of the opportunity as well as the various moving parts. And so one of the reasons I really like SPACs is the free look option. Essentially, a SPAC will begin trading around $10 per share. And so with a SPAC, what they do is they IPO, they put that money in the bank, then they go out and look for a deal. Once they announce the deal, if you don't like it, you can ask for your money back. Now, I've been doing this for 25 years, and I've never seen anything like this before, where essentially you get a free look on something with extremely limited downside and unlimited potential upside. So that's one of the reasons I've been really bullish on SPACs. You've seen a lot of money kind of pour into this space over the past couple of months. You've seen just really tremendous performance out of some of these deals. So I think it's super compelling. Typically, when you see this much capital flooding into one space, I start to get nervous, thinking, okay, the party's coming to an end. However, with SPACs, I think that, I think that the market is saturated. However, a pullback or a sell-off in SPACs, I don't think diminishes the opportunity. It actually improves the opportunity. And that's because you're getting the free look, you have the ability to ask for your money back. It creates a safety net, a downside safety net. So if you know that a SPAC has $10 in the bank, $10 per share in the bank, then your risk is somewhat limited to that $10 area. Now, in October, late October, going into the presidential elections, when people were pulling money out of the market, you did see a number of SPACs break the $10 level, fall to $9.50, $9 a share, kind of flash down there and bounce right back. Now, if I see that, it's going to be one of those days where I'll be in there kind of buying, just hand over fist, new SPACs, because yeah, being able to get something below trust value, I mean, that's really, it's hard to really ask for more than that. Now, the downside with SPACs is that once it IPOs, they typically have 2 years to find a deal. So you could have your money tied up. If you're investing in pre-deal SPACs, you can have your money tied up for up to 2 years. So I kind of approach it, and I posted this morning in my morning notes. I have a multi-pronged strategy with SPACs. I look at pre-deal SPACs, so names that are offered, that are being brought to market by compelling sponsors, people who have a history of starting companies, compelling exits, making money for their investors, creating value. Those are the types of sponsors that are going to attract venture companies, right? Like you don't want, if you're a really strong SPAC candidate or IPO candidate, you're not just going to go with the guy down the street, Joe Blow, who started a SPAC just because he could. You want to go with someone who adds value, right? Because you're giving up a percentage of your company to the SPAC sponsor. That was 20%. That is, in many cases, down to 10% now. But you're in bed with these people, right? You're giving them a piece of your company. They're probably getting onto your board. So you want people who can really help you. And so that's one of the ways I identify pre-deal SPACs. And, I like to buy those definitely below 11, ideally like in the 1030 to 1050 range. And I also look at SPACs where a deal has been announced. And, there are opportunities there as well. I mean, we have positions on right now that we bought in the $12 area. One I think is trading at 30. We have some that are trading at 20. We have another that's trading at, I think, 40. So, I mean, you can buy something at really attractive prices and get I think, most of these purchases that I'm talking about were made in December and January. So get 2, 3, 4 times upside pretty quickly when doing the work to identify the compelling names. Right now, investors go crazy over EV stocks, right? And that's what gets the pop, which really is kind of silly to me. What I'm looking for are the names that have long-term upside opportunity, 5 times, 10 times. I mean, I have one that I like. I think it's like, it has a lot of upside potential if they get the numbers right. I don't want to like tout it or anything, but has a lot of upside potential. Several of them have lots of upside potential if they run the business and hit the benchmarks that they say they're going to hit. So I think this is a really compelling part of the market, and it's really a place that investors and traders should familiarize themselves with. And I see that someone has a question.
Yeah, dude, it's Gavin here. I said we were talking about this before. All the money that's coming pouring in here. I know Brett and I were talking about new class of investors and stuff. I mean, am I right in thinking that a lot of this is just that VC money that's been coming off the sidelines, jumping in on this? It just seems like there's a never-ending area of issuance, either between SPAC or people running secondaries. And, it's just amazing to see the market continue to go up with all these dilutive actions being taken. Not that being a SPAC is a dilutive action, but obviously it takes investment money away from other areas. So where do you see most of the money flowing into these names from?
Yeah, so this is investing in SPACs is a new hedge fund strategy. So essentially what they're doing is they're able to take on leverage and invest at SPACs at up to 5 times leverage, right? And so what the strategy is you get in on the IPO of the SPAC, and most SPACs come with warrants. So when you participate in the IPO, the initial listing is of units, and units contain common shares and a partial warrant. So what a lot of these hedge funds are doing is, again, it's a free look, almost risk-free type of investment for them, is they're putting up the money to help the SPAC sponsor go public. They get the units. when the units and the warrants split, which is usually about 6 weeks after the deal hits, they sell the common shares and they keep the warrants, because essentially they sell the common shares for essentially what they paid for common shares and warrants, and they get the free upside look from the warrants. Does that make sense? And so they recycle that capital. Then they just move on to the next SPAC deal.
Well, I guess on that front too, you said after 2 years that an investor can demand their money back. If they are leveraging up here and demanding that money back, do we run into an issue similar to I guess the GameStop short, where you've got more units that are being offered than are actually available? Is that an issue that could come up down the road?
I'm trying to understand your question. Units available.
Okay, so a hedge fund's leveraging up to buy the units.
Yeah, they're selling them within like 6 weeks.
Within 6 weeks in exchange for the warrants.
Yeah, they keep the warrants. You're able to split when you have units. After about 6 weeks of trading, you're able to literally call your broker and say, "Hey, I want to split my units," and so they'll split them into common shares and warrants. And so you could sell one or the other. So what hedge funds are doing is selling the common shares and then keeping the warrants, because they're essentially getting the warrants for free.
Okay. All right. Yeah. Because I mean, again, for me, it's just a matter of appetite, where all this money's coming in, and trying to figure that out. And then just trying to figure out if they are leveraging up for this, is there pockets for, if we started seeing a market sell-off, if these hedge funds are all leveraged up, there's a chance for a little bit of a bigger collapse if they're forced to sell. But you're saying that most of them are out within 6 weeks and owning the warrants, and therefore work their way up the food chain in terms of payouts. So therefore, common's a little bit safer on a sell-off there, and not as leveraged up as we might fear.
Yeah, exactly. I mean, I think there could be. So if you have a period where everything, so you have 100 SPACs that go public in 1 month, and these hedge funds have on a lot of leverage, and they haven't had a chance to, the units haven't split yet, so they have a bunch of exposure to a ton of SPACs. I mean, you could have a period where you get a flush down in SPACs, right? Where, maybe the units trade down to $9 a share, maybe even lower than that. But again, that's, to me, that's free money. Like, you're taking advantage of someone's lack of liquidity. So that is not something that would scare me. That actually, I would welcome it. And literally probably be the most exciting thing I've seen in a long time. Now, the other part of SPACs in terms of the number of deals that are out there is that it's really important for the sponsor to do a good deal, right? Like, they can't just buy junk. And why is that? Because I can ask for my money back. And if enough people ask for their money back, the deal doesn't close. So what essentially happens is the SPAC sponsor has to go out and look for deals that investors are going to like. They want to see the stock price trading at 10. Most SPACs are $10 price. They want to see the stock trading at $12, $13, $14, $15, $16, because what they're also doing is coming back. So if you raise, say, for example, $200 million in a SPAC, that means that on average, I'd say that a company that raised $200 million is buying a company for $1 billion to $2 billion. So they actually have to go back out and raise additional money from institutional investors. And, it's a pipe. And they raise it at that $10 price, right? So if the stock's only trading at 11 or 10.50, people might not want to participate in that pipe. And you risk people redeeming, using the redemption option and getting their money back, and the deal not closing. So the economics, I think, are continuously in favor of the retail investor, because if the sponsor doesn't do the deal right, then the deal collapses, retail investor gets their money back, and the sponsor is actually on the hook for the costs incurred in that whole kind of research process to bring a deal public.
All right, Damon, with all that said, what are some of the names that you're really focusing on now?
Yeah, I like a lot of names.
But what are the hot ones?
Yeah, I mean, I guess I don't really. I mean, everything I own is up a lot. Yeah, so I mean, it's like if you just plug in the focus ticker, just take some time to read my comments and see what I say about them. I don't want people just going in and jumping into stuff. I want you to understand what I'm doing here, understand the process. Don't just blindly buy stuff because I'm touting it. These are venture investments. These are opportunities to make potentially life-changing wealth. So take time to understand the process and, research these names, follow these names. A lot of these companies that are coming public, you're buying them. I mean, it's venture, right? Like you're buying these on the promise of what things will look like in 2024, 2025, 2026. So it's a story that you need to follow and understand and keep up with, right? Like you don't want to just buy it and say, oh, I hope it goes to 100. Well, but then if it falls 30%, you sell. Like, you need to know the story so that it falls 30%. You say, hey, like, yeah, these people don't know what they're doing. Like, that's the fast money. That's the hot money. They got scared out. I'm buying this on this pullback to 15 for a move to 100, right? And so that's what we're playing here. We're not, this to me, this is serious business. You spend time understanding it.
So if you were to mention just a couple names that
yeah,
if
like
we did
so,
get
no,
such
so like for example, like someone just like people know what I like, right? And so they just ran one of these names up 18% into a trading halt in anticipation of me mentioning it. So that's exactly what I didn't want to happen, right? But it is a name that I like. And so if you do a search under I'm not going to mention the name, but if you do a search under the focus ticker, I've mentioned it recently, and yeah, or you look at the trading halt list, you'll find it.
All right.
Damon,
So,
I have a question.
ahead.
I want to just cut in here, Damon. Why recently has this become so popular? Why do you think? Because these stocks have, most of these blank check companies, they have been around lately. Why now? Why the last 3 months?
Yeah, because blank check companies really had a bad reputation before, and most of the deals that were done were value, over leveraged types of companies, right? So, it just wasn't exciting stuff. I mean, you could get plenty of that stuff in the regular stock market. Why do you need to go to a blank check company to find a company with a bunch of debt that's growing 4% per year that maybe you're getting a little bit cheaper than you might have otherwise? The transition has been, once you had the DraftKings deal, the Virgin Galactic deal, and people seeing the performance of those, you started to see legitimate sponsors raise SPACs, right? And so that's been the change. You have the biggest names in finance globally raising SPACs. So it's like, basically, I was going to say it's like Elon Musk tweeting, hey, I'm buying Bitcoin, but it's even greater than that because he does a lot of speculative things. Like, these are the titans of Wall Street. Like, almost every major player that you can think of has a SPAC out there. And so that's been the change, right? Like, people are putting their reputation on the line to get involved in SPACs. They want to bring good deals to the market. If they don't bring a good deal to the market, they can't come back with another SPAC, right? And so, so you're saying companies that do serial SPAC sponsorships, and they're able to do that because the last deal they did really well, or the last two deals they did really well. Mm-hmm. If you come out there and, throw out something that ends up crashing and burning, no one's going to ever want to touch one of your deals.
All right. Just for anybody doesn't want to take on those specific risks, there is an ETF out there that came out a couple months ago, SPAK, Sam Peter Alpha King, That's a SPAC ETF. And if you're looking for the holdings, that's also, I would say, a good way to start, doing some research and looking at some of these names, in addition to Damon's, stuff that he posts on the site there. The SPAC holdings, it looks like there's a lot. It looks, I would say, there's almost at least 50 different names in there that you can probably go through and start looking at. Top holdings include DraftKings, Open Door, Pershing Square, Churchill Capital. I mean, we've mentioned a bunch of these on the site. Virgin Galactic, Skills, SKLZ was a hot one as of late. Desktop Metal, and Vertiv Holdings. So that's good stuff.
All right, I want to shift gears just a little bit here and bring Brett, chart trader, into the discussion here and talk a little bit about the oil space. We've had a big extension in crude prices, Brett. We're inching closer to that $60 area. I want to know what you think is going on in this space.
Yeah, so this is something that I've been talking about for several months now. I don't want to take a lot of time because this meeting has gotten a little long in the tooth, but just to reinforce the point, there's a narrative that maybe we're moving past fossil fuels on a structural time frame, but the price of oil is going to infinity if we don't invest in expanding production soon, because you need to constantly invest in expanding production over time, or else you get behind the curve and you have a shortage risk. And last year, when the price of oil dipped to negative $40 per barrel because nobody could find any place to put it, there was just a complete stop in investing in new production. And from then on, we started this really difficult game theory landscape where everybody's just sitting there waiting for the next shutdown, the next lockdown, especially coming into the late fall, coming into the winter, coming into the new cold and flu season. There was still some uncertainty around vaccines, so we lost further months with really no significant investment in expanding production. And typically, there's a constant investment going on in expanding production. So when you lose that many months, you run into something on the other side of it, which we're seeing now, where you suddenly have trillions of dollars of economic stimulus, 5 different vaccines that are 100% effective in preventing the severe version of the illness, and you missed that many months of expanding investment in production. So either there's going to be a huge investment in expanding oil production, or the price of oil is going to infinity. And I think the more likely thing is we're going to see a huge investment in expanding oil production, which means a lot of these stocks that got left behind pretty much for the entire second half of last year, as the rest of the stock market went through the roof, they're sitting there way down, well below their early 2020 highs, just at the point where we're going to need to start pouring a ton of money into what really hits the bottom line. So the oil space is an interesting space when you talk about on the equities level. I've been bullish on crude oil. We are continuing higher because we still haven't seen really that kind of switching on of the whole system, and you're getting to the point closer and closer where you have some kind of shortage risk, and I don't think it's being discussed enough. Curve right now, if you look at the forward curve in oil, is huge, steep backwardation. That's basically the market incentivizing people to produce and sell now rather than leave it in the ground or rather than store it. It's the market's way of kind of urging on a bull market. Generally speaking, in crude oil, when you get a real deal bull market in the oil space, you get a backwardation in the forward curve, and that's what we're seeing right now. So it's an area that's been left behind, and if you're looking for a place, that's probably a good place to be looking.
All right,
Okay.
Damien, did you want to jump back in?
Yeah, so I gave myself too much credit for moving a stock just because I have seen on these meetings people bid up stocks that they know that I'm bullish on ahead of me speaking. So NPA, Nancy Paul Apple, is the stock that I was talking about that I didn't want to mention by name because I was concerned that people would just pile into it. I mentioned it yesterday that I trimmed 1/4 of the position on our options trade for, I think, 73% in about a week. And, I still love this name, and it hurt me to even take off any. We own the common shares from, I think, $10.30. We own the warrants at a very low price. The stock just popped 30% in reaction to a Citron report. So Citron Research has come out while we were talking, with a $50 price target on the stock, which it is currently trading at 23.77, saying that it is the most compelling space 5G ESG story in the market. All SPACs are speculative, so why not go with one with a $1 trillion TAM, total addressable market, that has the potential to change the world with real partnerships, the most important space story in the market. So yeah, I mean, that's kind of what I've been saying, since 10 bucks, basically. I've highlighted NPA numerous times. Not only do we own the common, but I think, yeah, basically a little bit over a week ago, I came out with a new report, also buying the warrants, doubling up. It's actually my largest position. $50 is, I mean, if they get this right, I mean, $50 isn't an aggressive price target at all in my mind, right? So again, don't just pile into this name. Do your research, understand it. They get it right, this is going to be a big winner. So everyone's excited about SpaceX and Starlink potentially coming to the market. This has components of both of those, and they have really compelling relationships. So it's not as speculative as many of the SPACs out there. And the other thing is, if this plays out correctly, the margins are through the gross margin. So this will trade with essentially software multiples. So you can just plug in NPA ticker search and see what I've said about it. I have links to a variety of different reports and the investor presentation. But again, this is with SPACs. We're not looking for $1, right? We're looking for ideally $30, $50, $100. That's venture capital investing. That's what SPACs provide the opportunity for.
So Damon, when you change your handle from Scalp Trader to SPAC Trader, should we be scared?
Yeah. Yeah, I've been, doing a lot of non-scalping stuff for a number of years now. So yeah. I could have turned it to a distress trader, G trader, yeah. A variety of different types of trading. So yeah, I'll keep it at Scalp. Yeah.
Cool.
All right, gentlemen, unless there's anything that we haven't uncovered, I think we will wrap this one up. I want to thank everybody for participating today. Thank the audience out there and the questions. I was able to kind of sprinkle them in, and we were able to see some of them. If we didn't get to them, if you have something more specific, feel free to email our team, use the Talk to Us button, or email them directly. They're very good about getting back to specific questions. Keep it as poignant as possible. Give us as much detail as you can. And with that said, I will wrap this one up. Thank you guys. And we will have a recording of this in the not too distant future. And we want to wish everyone happy trading. And thanks again for participating.